Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis on Friday, October 31. Happy Halloween, 2014. You're looking at a daily chart of the SPY, and last night I told you that the maximum upside I thought was between 200.50, 275 in that neighborhood. Well, today you had what's called a gap and go. So we jumped right over this gap that I told you would be resistance, and we went higher. And that happens, and so I was wrong on the maximum I thought the market would go. But what I will tell you is don't get too happy yet. While I think there are higher prices ahead for an end-of-the-year rally and into next year, you're going to have a pullback. The election is going to act as a catalyst to the pullback. You're going to hear stuff like, oh no, it's not going the way we thought, or there's going to be a runoff in 2 states, therefore we're not going to know who's elected and whether the Democrats or the Republicans have the Senate until January. You're going to hear all kinds of stuff. That'll most likely be the catalyst for a pullback. This is a power move from the low down here. You have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 sessions with 2 down days, and you may get a float up on Monday. Who knows? You may punch through and make a new high on Monday, and then look for a reversal sometime Tuesday to mid next week, and then you'll get the correction that I've been discussing. So, albeit we jumped over the target I had, I still think it'll play out that way. I think this is just too overbought. It's got to pull back. You're hearing, market new all-time highs, this, that, and the other thing, and that's fine. But, everybody's giddy. Everybody's bullish again. Too far, too fast. There's no doubt about it. It's very obvious on the chart. Too far, too fast. It's going to pull back. But, I've told you many, many times that these markets move in like zigzag patterns or ABC patterns. So guess what? Remember I was saying A, B, C, and we would top out around here or something like that. I was to say A may be up to the 200, and then we pull back, and then we go a C leg up to here. Maybe this was the target in this neighborhood here. Well, we certainly went higher, but guess what? Now I'm looking at A, B, C. Okay, so if we top out here, that'll be your A leg. B, C, that's a corrective pattern, okay? So we'll see how that plays out. I feel pretty good about that one. It just looks good to me. It looks like there's this has got to set up the pullback, and I don't think the pullback is going to get anywhere near this low here. But certainly things can change, and if the markets start propelling on the downside, I'll certainly discuss it with you here in these videos, and we'll act accordingly. Okay, so might as well discuss for a second what caused this jump today. Overnight, the Bank of Japan came out with another quantitative easing program or money printing program. Basically, what they're going to do is they're going to buy bonds and they're going to buy actual equities and ETFs or exchange-traded funds for their pension funds, and who knows what else they're going to buy. They're going to buy whatever they feel like buying, and they're going to be a put underneath the market for a while. And don't forget, everybody was expecting European Central Bank, Mario Draghi, to come out with a quantitative easing program. And I really do think now, looking back, I think that's the reason the market was propelled higher, was on the anticipation of Mario Draghi coming out, selling Germany that he wants to do this and let him do it because they can veto. And I think the market was propelled assuming that Mario Draghi was going to do it, right? Now, guess what? Bank of Japan comes out from left field, issues a huge, trillion or multi-trillion dollar program, whatever it is. Who cares what it is? It's a put under the market, right? And then what'll happen is it's going to be a sell the news event, right? We rallied up today, and then somebody will come out with some nonsense next week, whether it's the election or something else economic-wise or whatever it is. Maybe it's Ebola again. Who knows? And they'll sell off the markets for a while, and then Mario Draghi will come to the window with his version of the quantitative easing program. And guess what, folks? Both these programs replace the Federal Reserve's program that they just ended, and guess what? nothing happens to the markets. If the markets were floating up based on the Fed put, then they'll be floating up based on the Bank of Japan and the European Central Bank put. And that's just the way it is until further notice. Once the central banks, and there will come a day, whether it's next month or in next year or in 3 years or whatever it is, there will come a day when we don't trust the central banks anymore to be a put on the market, and that's over. Right now it's on. Sooner or later it will be over. We'll know it when we see it, but right now it's on. So you have to act accordingly. All right. Let's jump over to the let's jump right into the gold market. So gold got just shellacked today, right? Let's look at a monthly chart of gold because we're going to get the picture in here pretty good. All right. Now we've come under, this was support, okay? This low, and this low, and this low was support, okay? Now you've broken support, and where do you go? Okay, well, I'm going to tell you where you go. Basically, the price of spot crude, I'm sorry, we're not talking about crude. The price of gold futures right now is 1173. It was 1171, I believe, around there at the close today, and then there's an after-hours session. So it's up a little bit, but 1173. We're going to look for a low in between 11 and a quarter and 1100, somewhere in that neighborhood. We're going to look for a low, and it's not going to be the final low, I don't believe, but it's certainly going to be a good enough low for a rally. And what that translates to in the price of GLD is that's going to be somewhere around 95 to 90, call it 97, really more comfortable, 96, 97, in that neighborhood, okay? Maybe this pivot high or this pivot low here. Somewhere in this, all this support here is where you're going to go. There's no, I'm not going to try and pinpoint it for you because as I always say, it's a fool's game. Sometimes I have a number, sometimes I don't. And evidence was last night. I had a number on the E-mini contract, the ES contract. I thought 199, I'm sorry, 1,099, I can't talk. 1999 was going to be the top end. And we jumped over it. And basically, when you have one of those gap and go scenarios, it's very rare, unless you have a big reversal day, which we didn't have. It's very rare that you go underneath that initial gap level where it opened up for the day. So we jumped over it, and we'll see if it pulls back, and that maximum move should hold in terms of acting as resistance for this market and see a pullback. So we'll see what happens from there. But basically, you're looking at maybe the lowest low I would anticipate is about 95, and 97 would be a range. 95 to 97 is a great target to begin to pick up some GLD for a rally. All right, let's go over to the USO. We'll talk a little bit about oil. Now here, we'll stay on the monthly for a second, because I still contend that the price of crude oil, which today dipped below 80 and then it popped back up, it's at 80.70, I think you still go to 75. And $5 is going to translate down to about 28, maybe 27 and a half, $28, maybe $27 in the price of USO. We'll have to, I'll do more calculation as we get closer if we break 80 on a closing basis, and then it looks like we're heading to 75. So that's where I stand in crude. And, you know, if you think about it, the yen is collapsing based on the Bank of Japan's actions overnight. Okay, so the dollar yen rallied, the yen collapsed. Okay, the U.S. dollar rallied, gold collapsed. Oil didn't do much. It tried to go down a little bit, but it didn't really get very far. But if I'm seeing lower prices in gold and I am seeing higher prices in the U.S. dollar, okay, then it does make sense that oil could possibly get hit. And oh, by the way, if we're going to see a market sell-off, which I believe is coming beginning next week, and oil's been attached to the market somewhat through this down move and then up move over the last, well, just call it the month of, even from September, the beginning of the decline. So basically, if oil is still attached to the stock market and gold's going lower and the stock market's going lower and the dollar's going higher, I don't see any way in the world that oil can hold up and rally in the face of all that stuff. So I have to be dead wrong about all those other markets, which I don't think I am. And that would make me dead wrong on oil. But there's just that's the common sense part of this. It's not like I see a number and say we have to go here. But in this particular case, I can't make a case for oil getting stronger right now. And right now, I mean this week, next week, the week after, that type of thing. What happens in December or later November, I don't know. We'll address it when we get there. I'm talking about the next trade, and I just can't make a case for higher prices in oil right now. So that's where we stand. All right, folks. It's Halloween. I'm going to leave it there. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.